Imagine this. You wake up to a world where the banks you rely on are dark, not just slow. Your debit card won't swipe, your online banking won't load, and you can't move money to pay your rent or buy groceries. The ATM shows unable to dispense cash or simply refuses to connect. Your employer's payroll, once a ritual that lands like clockwork, is nowhere to be found in your account. Even though the city outside looks the same, inside people move differently, tentative, uneasy, checking their screens every few minutes for a glimmer of normal. You're not dreaming. This is a crisis scenario in which every bank in the system has effectively shut down for a full week. If the week stretches, the consequences compound, and the social contract begins to fray. Let's set the scene clearly before we zoom in on what happens next. The premise is simple but brutal. A coordinated, albeit unintended, run on centralized banking infrastructure collapses the payment, settlement, and credit lifelines that modern economies rely on. This isn't a movie plot or a hypothetical quiz. It's a structural shock to the backbone of daily life. A week is long enough to reveal fault lines, but short enough that actors across society still remember normality, which makes telegraphed reactions highly informative for our understanding of risk. On day one, the most visible symptoms are the most mundane. A cascade of failed transactions, delayed salaries, and the eerie quiet of a city where the cash you thought you carried in your pocket is suddenly less reliable than your memory. The mortgage you scheduled to come due today? It's unclear whether the funds will clear on time. Your grocery store's scanner might function, but the digital payment terminal won't process. And if you manage a small business, you sense the tremor in your cash flow the moment you try to pay suppliers or staff. Without liquidity, your operations could stall, and with that stall, credibility erodes. To understand the chain reaction, we'll move through 5 layers of impact, each feeding the next. Layer 1 is the immediate disruption of payment rails. Debit and credit networks, ACH transfers, wire transfers, card networks, and the check clearing system depend on centralized banks, clearinghouses, and custodial institutions. When the banks close, the rails go dark. Without a predictable, trusted path for funds to move from buyer to seller, commerce, the daily exchange that keeps lights on and shelves stocked, slows to a crawl. Layer 2 concerns liquidity. Even if some deposits are technically secure, the actual cash available to institutions to fund withdrawals, payrolls, and credit lines shrinks because the liquidity lifelines, interbank lending, central bank facilities, and market-based funding, freeze in the short term. Layer 3 is confidence. In a crisis, confidence is not a luxury. It is a liquidity itself. If people doubt the banking system's reliability, they begin to hoard cash, postpone payments, and reprice risk in every decision, creating a self-fulfilling crisis. Layer 4 concerns the government's ability to restore order. Policy tools exist in abundance on paper, but the timing, scale, and political will to deploy them quickly become decisive. Layer 5 is the path to recovery. Recovery hinges on credible backstops, restored lines of credit, and a re-established trust in the system's ability to protect everyday money, without which growth cannot resume in earnest. The immediate hours, day 0 into day 1, unfold with astonishing rapidity. You check your accounts and see zeros where there are supposed to be numbers. The payroll you expected at 9 a.m. is delayed. The human resources portal that you rely on to verify benefits is unresponsive. Banks issue dry press statements, regulators convene emergency meetings, the stock market hesitates, then trembles. In the real economy, a 1-week shutdown creates a demand shock larger than many people expect. People pull back on discretionary purchases, households cut back on energy usage as a precaution, and small businesses, especially those with tight cash flows, face the choice between furloughs, short-time work hours, or delayed supplier payments. The first 24 to 48 hours look like a sudden freeze in discretionary spending, but the longer you stay in the dark, the more essential the financial plumbing becomes. Without the ability to settle invoices or access working capital, even essential services, grocers, hospitals, municipal services face stress. Liquidity crunch. This is the moment the question, what would break first, becomes both a diagnostic tool and a warning. Banks support liquidity not just by holding cash reserves, but by lending against collateral, by participating in interbank markets, and by accessing facilities offered by the central bank. In a shutdown, interbank markets seize up as banks become wary of counterparty risk. Without trust in the clearing mechanism, even solvent institutions can become temporarily illiquid because they cannot access funding or unwind complex positions safely. The central bank steps in, but even that intervention has a time lag and a credibility curve. The Fed's role in a scenario like this would be both reflexive and strategic. It would deploy emergency liquidity facilities, widen existing facilities, and work to reassure markets that solvent institutions would receive funding when needed. The immediate fear, will the emergency liquidity be enough to prevent a full-blown bank run, is not merely economic. It is existential for millions who depend on the system's continuity for their daily lives. Think of a few concrete scenes you'd expect to see across the economy. A midtown law firm must halt payroll. A family store cannot pay suppliers. A hospital must manage patient care with reduced cash flow because suppliers demand faster payment terms and some credit lines are suspended. A school district faces delayed vendor payments while city services may scale back non-essential programs to preserve liquidity for essential functions. People who live paycheck to paycheck feel the pinch first, but long-term stability matters even more for those with mortgages, car loans, student loans, and other forms of structured debt. The longer this lasts, the more pervasive the implications become. Delayed renewals of leases and mortgage modifications, a spike in credit card balances as people bridge gaps, and a potential increase in non-performing loans that could feed back into higher charges and tighter lending standards once banks reopen. Government responses: fast, medium, and slow. The first lever is liquidity support, a rapid deployment of emergency lending facilities, with guarantees that provide banks with usable capital to honor withdrawals and fund ongoing operations. The central bank would coordinate with the Treasury to underwrite the most essential payments, like payroll, Social Security, and public sector salaries, so people can avoid catastrophic cash flow failures. A second lever is systemic guarantees for deposits. Governments or deposit insurance schemes would announce credible, time-bound guarantees on consumer deposits up to a certain threshold, with phased steps to cover the majority of ordinary households while calibrating expectations to avoid moral hazard. A third lever is continuity of critical infrastructure. The government would focus on maintaining healthcare, public safety, energy, water, and food supply, ensuring that these pillars have the liquidity and access they require to operate. A fourth lever is a temporary, supervised reopening of the core payment rails. This would be a phased, highly controlled process designed to reestablish confidence without risking a new wave of panic. Each step would be accompanied by transparent communication, a clear timetable, and measurable milestones so the public can see progress and adjust expectations. A realistic, staged path of government action might unfold like this. First, within 24 hours, the central bank announces an expanded temporary liquidity facility, an emergency mechanism that accepts a wider array of collateral and offers favorable terms to lenders facing liquidity stress. Second, within 48 to 72 hours, deposit insurance schemes restore confidence by committing to protect ordinary savers up to a threshold, with a plan to scale protections as needed. Third, within the first week, the government rolls out targeted supports for households and businesses, income support for unemployed workers, small business grants or loans to bridge payables and payroll, and debt relief for essential borrowers. Fourth, as confidence stabilizes, the core payment system is gradually reactivated in a controlled manner, with clear limits and robust oversight to prevent a relapse into panic. The objective is not merely to relaunch the engine of money, but to restore trust in the engine's reliability. Recovery paths, 2 tracks converging toward normality. Track 1 is the financial access track. Banks reopen, and the public regains access to deposits, card transactions, and wire transfers. The process is staged, with enhanced liquidity facilities remaining in place until the system demonstrates resilience, not just momentary stabilization. The second track is the real economy recovery. Credit lines reopen to households and businesses, supplier chains reestablish, and confidence returns as firms can forecast cash flows again. The two tracks reinforce each other. The reopening of banks fuels the recovery of business activity, while a healthier economy reduces the pressure on banks to tighten credit further. It's not a single flip of a switch. It's a process of rebuilding trust, repairing the balance sheets that were stressed, and recalibrating risk. In aggregate, the crisis reveals three enduring truths about modern finance. Liquidity is not a toggle you can switch on and off without consequence. Confidence is the most critical asset for a monetary system, and robust backstops must be designed not for tranquility, but for the moment when the system actually faces stress. But what does the week-long shutdown teach us about safeguards today? The key takeaways are actionable and forward-looking, not panic-inducing. First, diversification of payment rails matters. The more you rely on a single platform or a single bank for day-to-day operations, the more exposed you are to a single point of failure. Redundancies, such as alternative payment arrangements, trusted cash reserves for urgent uses, or access to non-bank payment mechanisms, provide a buffer. Second, liquidity planning isn't a luxury. It's a core financial discipline for both households and businesses. Firms should maintain access to lines of credit that can be drawn quickly without punitive penalties, and households should keep an emergency fund that can cover several weeks of essential expenses. Third, public policy design matters. A credible, clearly communicated backstop from the government can dramatically shorten the duration of panic. Transparency, about what is guaranteed for how long and under what conditions, reduces uncertainty and dampens reflexive withdrawals. Fourth, the crisis underscores the importance of resilient public infrastructure. A well-functioning payments system relies on a set of interconnected, well-capitalized institutions that are prepared to operate under stress. That means regulators, central banks, and financial institutions must practice crisis drills, align on backstops, and maintain the capability to scale operations quickly. Finally, adaptivity matters. The crisis scenario is not about predicting the exact sequence of events, but about understanding the levers that would be pulled when the system faces extreme stress. The more flexible and credible those levers are, the shorter the disruption will be. If you're watching this and thinking, what can I do today to be prepared if something like this happened tomorrow? Here are practical steps you can take, each grounded in the same logic that guides crisis planning for financial systems. First, build a household emergency fund that covers at least 2 to 3 months of essential living expenses. Not just a cushion for a rainy day, but a buffer across multiple failure modes. Second, diversify your financial relationships. Don't rely on a single bank or a single payment channel for everything you do. Spread essential transactions across a few trusted providers where feasible, and consider secure, low-risk cash reserves for critical days. Third, keep copies of essential financial documents in a safe, accessible place. Proof of income, bank account details, policy numbers for insurance, and contact information for your financial institutions. Fourth, maintain a basic electronic payment plan that doesn't rely on a single rails provider. For example, have an alternate digital wallet, a debit option with a different network, and a small personal note about where you can transfer funds manually if the digital channels fail. Fifth, stay informed about public policy developments. In times of crisis, credible official communication matters as much as the underlying interventions. Knowing what the government and regulators are doing and when can reduce uncertainty and guide prudent personal decisions. To close, let's return to the opening question with the lens of a practical takeaway. A week without banks is not merely a temporary discomfort. It tests the social contract that money and trust enable. It reveals where the system is robust and where it is brittle, and it shows that the architecture of modern finance isn't just about clever algorithms or brilliant economists. It's about human behavior under stress, about the speed and clarity with which institutions can act, and about the capacity of a society to come together to protect the basics, pay, shelter, food, health, and the right to participate in the economy. In the end, the crisis simulation isn't a forecast. It's a warning that resilience demands foresight. It invites policymakers to invest in credible backstops, in well-planned contingencies, and in transparent communications. It invites individuals and businesses to prepare, not out of fear, but out of discipline and pragmatism. If we take those lessons seriously, the week-long shutdown becomes not a catastrophe to dread, but a catalyst for strengthening the safeguards that keep money moving when it matters most. If you found this thought experiment enlightening, consider subscribing for more deep dives like this, where we translate complex financial mechanics into practical takeaways for everyday life. In the next episodes, we'll unpack how specific backstops work in real time, analyze how different countries would respond given unique regulatory frameworks, and explore what small businesses can do now to build more resilience into their operations. If you have questions about a particular scenario, say, what happens to mortgage payments, or how small banks' liquidity management would differ from large universal banks, drop your questions in the comments and we'll tackle them in a future installment. Until then, stay curious, stay prepared, and remember, money is a system built by people and its resilience rests on the choices we make today.